All right, let's get into it. This past week in the markets, wow, it felt like trying to solve a puzzle where none of the pieces seemed to fit. We had trade tensions heating up, signs of a global slowdown, and then this surprising strength in some really unexpected places. So today, we're going to try and connect those dots and make sense of what was a truly wild week. So let's just dive right in. The big question on pretty much every investor's mind this week was simple. Are we gearing up for a major rally, or are we staring down a painful recession? The signals were flying in from all sides, and honestly, they were pointing in completely opposite directions. It created this real sense of whiplash in the market. So what was causing all this chaos? Well, on one hand, you had this huge threat of new tariffs between the US and China, just hanging over everything. But then, on the other hand, the Federal Reserve started talking like they were way more open to cutting rates. And if that wasn't enough, you throw in a slowing Chinese economy and a crypto market that was just absolutely on fire. It's the perfect recipe for volatility. So let's dig into each one of these. First up, let's talk about the central banks, because you've got the two biggest economic players in the world, the US and China. And right now, they're heading in totally opposite directions when it comes to their money policy. And this split is a massive driver of everything we're seeing. And this right here really lays out just how different things are. Over in the US, September inflation came in a little cooler than people thought at 3.0%. The market, it immediately jumped on that, pricing in a 99% chance of a rate cut from the Fed. That's what we call a dovish stance. Basically, they're leaning towards lower interest rates to get the economy going. For assets, that's a huge green light. Now, flip over to China, and it's a totally different story. They're holding rates steady, but their economy is sputtering. Third quarter GDP was the weakest it's been in a year, and they're fighting off deflation. Two very, very different worlds. And all of this is happening while these geopolitical tensions are bubbling up, which was the second major thing shaking up the markets this week. I mean, trade policy and these high-stakes political moves, this wasn't just some noise in the background, you know? This stuff was actually moving the needle. And the real spark that lit the fire? It was this announcement, a potential 155% tariff on Chinese goods. I mean, that threat alone sent a massive chill through global supply chains and just cranked up the tension right before this super important summit between Trump and Xi Jinping. Yeah, we're not talking about a small tweak here. This was a massive escalation. You know, this quote from Michael Hartnett over at Bank of America, it just nails it. He's saying we've walked into a new era of geopolitical risk. Basically, political games have now become a primary factor for investors. It's like the old rules, they might not work anymore, and you can feel the effects of that everywhere. And you can really see how this stuff ripples out and hits specific sectors, like the European banks. While banks in the US have been holding up pretty well, their counterparts over in Europe are definitely feeling the heat. It's a mix of these global pressures and their own internal problems. Like Lloyd's is dealing with an auto financing scandal. Barclays has to set aside a ton of money for legal provisions. It just shows how fragile parts of the system are when things get stressful. Okay, so while all the traditional markets were kind of bracing for impact, one sector was just on a different planet. Crypto didn't just get through the volatility, it actually seemed to be thriving. And what's fascinating is why. It's the story of crypto kind of breaking away from the usual market fears and running on its own powerful story of institutional and political acceptance. So what was the rocket fuel here? Well, it was just this storm of super bullish news that basically created its own weather system. You had a presidential pardon for the founder of Binance, CZ, which sent a huge signal that the administration was shifting to be pro-crypto. Then you had a plan to nominate a friendly face to run the CFTC. And maybe the biggest deal of all, a record $5.95 billion poured into institutional ETFs. I mean, these catalysts were so strong that even after a nasty 25% drop, Bitcoin just roared back to $111,000. So yeah, you can just feel the optimism. Some analysts are looking at Bitcoin's historical 4-year cycles, and they're now projecting a potential move past the $185,000 mark. Look, of course, that's just one analysis, right? But it perfectly captures the incredibly bullish mood that completely took over this week. Okay, so let's recap. We've got a dovish Fed, we've got geopolitical drama, and we've got a crypto market that's on a tear. How in the world do you pull all these pieces together to form some kind of strategy for the rest of the year? Let's try and put this puzzle together. Okay, so here's one way this could all play out, like a chain reaction. It starts with the pardon for CZ. That creates this huge wave of pro-crypto sentiment. At the exact same time, you have Fed Chair Powell's dovish signals pushing bond yields down, which makes riskier things like stocks and crypto look way more attractive. You put those two things together, and you get a very powerful recipe for a strong rally to end the year. But hold on, it's not all smooth sailing. You've got a word of warning here from a legend, Ray Dalio, and he's reminding us all to be careful about these global debt cycles. And his message is really simple, but it's so important. In an environment this unpredictable, diversification isn't just a smart move, it's absolutely essential. So what does that actually look like in a portfolio? Well, based on everything we've talked about, here's one possible way to set things up. You'd lean into growth with a big 60% chunk in equities, especially US tech. But you're also hedging your bets, right? So 20% in fixed income, a little 5% in gold for safety, and then a pretty significant 15% in Bitcoin and Ethereum to catch that wave of institutional crypto money. All right, so let's boil this all down. The big picture is this. We've got a Fed that's basically giving a green light to the markets. We have big institutional money finally taking crypto seriously. But the risk of that trade war blowing up is very, very real. And that means the one thing you absolutely have to keep your eyes on is that upcoming summit between Trump and Xi. The outcome there could really set the tone for everything. And that really brings us to the big final question, doesn't it? It feels like all the pieces are in place for a really powerful rally in the fourth quarter. The conditions look good, but the huge unknown is, will geopolitics show up and crash the party? We'll be watching right along with you. Thanks for joining me.